Okay, let's unpack this. We received a fascinating set of sources that detail a massive and honestly pretty counterintuitive movement in American finance right now.
It really is.
For years, the default setting has been, pour every extra dollar into the stock market. You're always chasing growth.
Relentlessly.
Exactly. You'd think that in a booming economy, the flow would be entirely toward all that exciting volatility and, high risk, high reward plays.
But the data is telling a completely different story.
Right. Instead, our sources are highlighting this widespread strategic reversal. Investors are pulling capital out of those exciting market opportunities and parking it in the most traditionally boring place imaginable.
Simple liquid cash.
Simple cash. So this deep dive is all about understanding why liquidity all of a sudden became the star of the financial show.
Well, the sources you provided map this migration out pretty clearly. It's being driven almost entirely by the current sustained high interest rate environment. So our mission today is to really analyze the logic behind this major shift, this move from speculation and market growth toward what we're calling strategic liquidity.
And what does this behavior really tell us about managing wealth when the cost of capital is this high?
That's the core question.
So we have to start with the fundamental question that our sources pose. Why exactly are Americans pulling money out of stocks right now and deciding to just settle for cash? I mean, on the surface, especially for someone who's been a buy and hold investor for decades, it feels like giving up,
Yeah.
like you're quitting on potential long-term gains.
It's a compelling question, but the answer is, well, it's purely mathematical at this point. The yield that's available on the truly safe side of the balance sheet is suddenly competitive.
Competitive in a way it hasn't been for a long, long time.
Perhaps for the first time in 2 decades. We're talking about high-yield savings accounts, HYSAs, and their cousins, like institutional money market funds. They're consistently offering yields in the neighborhood of, what, 4 to 5%?
4 to 5% on cash that is instantly accessible, fully liquid, and subject to virtually zero risk of principal loss.
That figure, that 4 to 5%, is the core engine of this entire movement.
It just significantly lowers the mental bar for investors, right, when they're deciding where to put their capital.
And you have to remember the historical context. For the vast majority of the last, low-rate cycle,